What if I told you that there is a company that turns literal garbage into gold, and they have been doing it for 14 years straight with constant growth in their sales and profits every year? While most of the people look at old car batteries and scrap metal as trash, this Indian company sees dollar signs, and they have grown their sales and profits by almost 2x in just 3 years. But here's a twist that will actually blow your mind. Picture this: a stock crashes 35% from its peak. Retail investors run away in fear. But in the shadows, the FIIs, foreign institutional investors, and the domestic giants are quietly but at the same time aggressively buying the stock to increase their stake in the company. So, is this a good stock to buy, or is it a trap for the retail investors? By the end of the video, we will come to know who is right and whether we should buy the stock or not. So watch the video till the end, because this video will change how you think about boring businesses forever. So today, let's meet Gravita India, a company that most of the people have never heard of but should absolutely know about if they are investing in the markets. Think of them as the Netflix of recycling. But instead of streaming shows, they are streaming profits from waste. Imagine that every time you threw away a plastic bottle, someone is turning it into something worth 10 times more. And that is essentially Gravita's business model, except they do it with lead, aluminium, and plastic on a massive global scale. And this is not just about one company. This is about a massive shift happening right under our noses that most of the investors are completely missing. Now everyone is chasing AI and data centers, but while they are up looking at the clouds, the real money is being made from what's literally under their feet: trash. Now the planet is running out of raw materials, but we are drowning in trash. And a few of the smart companies have figured out a way to turn that problem into pure profits. And Gravita India is one of them. Now, the three insights which I am about to reveal might completely change how you see Gravita. This actually might be the key to knowing whether Gravita is a hidden gem or a risky trap. So stay with me till the end, because you do not want to miss this. First insight: in 2014, Gravita made 22 crores in profit, and last year 313 crores. That's not 10 or 20% growth. That is a 46% compounded annual growth for a decade straight. Now, let me put this into perspective. Whenever a company delivers such explosive growth, it is often called as a wealth creator. Like Bajaj Finance, a staggering 34% compounded profit growth for a decade straight. You can just pull up its 10-year chart and you will see the story for yourself. So the numbers do not just tell, they scream success. So just pause and see the chart for yourself. But wait, here is the crazy part. Gravita India made such high profits while paying dividends every single year for 14 years. While most of the high growth companies burn cash, these guys, they were printing it and distributing it among the investors. Which brings us to my second insight, which explains why smart money is moving in. The FIIs, the guys with $1 billion worth of research team, have increased their stake from 0% to 15% over the last 5 years. That is a crazy increase in their position. Think of it like the smartest kids in your class started copying from one single student's paper. So you would also want to know what that student knows, right? Now, in May of 2025, when the stock was falling, Abu Dhabi Investment Authority and Goldman Sachs funds were aggressively buying the stock. Now, these are not day traders. These are institutions that think in decades. Meanwhile, the promoters were selling their stake from 73% to 55.88%. That is 17% stake over the last 5 years. Now, this could be concerning, but there is a twist. The twist is that every share that the promoter sold was immediately absorbed by the institutions. It is like a game of musical chair, except Only the smart money gets to sit down. But before you think everything is all sunshine and rainbows, there is a third insight that changes everything. So here is the uncomfortable truth. The stock is expensive, like really expensive. The PE ratio is 38. To put that into perspective, the stock usually trades between 15 and 20 PE with a 5-year median PE of 20. Now, in simple terms, you are paying double than its usual price. Imagine that you're handing over 200 rupees for a 100 rupees note just because you believe that it's worth it. Now, see, expensive doesn't always mean bad. Tesla was expensive for years before it justified its valuation. Now, Gravita is showing high growth. As a result, the valuation is also high. But it does mean that you need to be extra careful about it when you buy the stock. Now, the million rupee question comes. And that is where things get really interesting. Now, our analysis shows that 1650 to 1550 is a good support zone for the stock. But accumulating over here can be risky as the stock is in a downtrend, plus it is also trading at a premium valuation. So here I would either wait for the stock to give a breakout on the upside and sustain above the downtrend line, or wait for a cheaper valuation around 1350 to 1380 zone. Now here's my take. According to me, the best thing that you can do is wait. But the stock is definitely on my radar, and Gravita India is a masterclass on how one can create extraordinary wealth from a boring business. Now they have proven that they can execute. They have built a global moat in recycling, and they are positioned perfectly for the circular economy boom. But timing is everything in investing, and sometimes even the best of the companies can make the worst investments if you buy them at a high value. So for now, do not go and buy the stock today. Go back a minute and see the analysis one more time, mark the levels on your chart and track them regularly. So drop a comment below and let me know, what do you think? Pay premium for quality now or wait for a better price? What makes sense? Do let me know in the comments, and I read each and every comment. And sometimes some of you have insights that even surprise me. So if this deep dive style of analysis is your thing, then subscribe to Ranga One, because your growth is our priority. See you in the next one. Bye bye. While the market gave crazy returns, these two sectors left the investors crying. But there is a twist. So this underperformance of these two sectors might be setting up the biggest opportunity of the next few years. So I ran every major FMCG stock through these two filters. 47 companies, hours of analysis, but two names dominated every single metric. And the first one is